In each year since 2000, at least 14% of all public companies have filed going concern opinions, and that percentage goes up to between 17 and 21% in the past 5 years, according to a recent report by Audit Analytics in December of 2012. This time period in a company's life cycle is particularly challenging and requires a lot of really complex judgments. And some of this complexity is why the FASB took on a project to develop financial reporting requirements for preparers related to going concern assessments. On June 26, 2013, the FASB issued an invitation to comment on its proposed ASU, Presentation of Financial Statements, Topic 205, Disclosures of Uncertainties about an Entity's Going Concern Presumption. Hello and welcome to KPMG's podcast to discuss the proposed ASU, Disclosure of Uncertainties about an Entity's Going Concern Presumption. My name is Jeremy Peters. I'm a senior manager in KPMG's Department of Professional Practice. This podcast was recorded on August 9th, 2013, and for the next 20 minutes or so, I'll highlight some of the key areas of this proposed ASU. Okay, well, we thought it would be helpful to start today's podcast with a bit of background on this development of this standard, as it's had a long history in its development. So to start, what was the original scope of the project, and why did the FASB determine it was necessary to take this on? Well, it was really to address an apparent gap in the accounting literature, whereby any of the assessments related to going concern really resided in the auditing literature. And so development of this project was really to incorporate in U.S. GAAP some of the provisions, particularly in AU 341, or as clarified in the clarified standard section 570, the auditor's consideration of an entity's ability to continue as a going concern. The project was also intended to converge some of the guidance with existing IFRS guidance, and that was primarily resident in IAS 1, Presentation of Financial Statements, and IAS 10, Events After the Balance Sheet Date. And so that original project got underway, and there was an exposure draft that was initially issued way back in October of 2008. And so if we flip to the next slide, we'll give an overview of the timeline since 2008. Just to give you a quick picture of what's been going on in this project, as you can see on the left-hand slide, the initial exposure draft I mentioned was issued in October of 2008. Subsequent to that, the boards deliberated at a number of meetings, and in June of 2009 decided to add liquidation basis of accounting to the project scope. Subsequent to that board meeting, the FASB staff went back and they prepared a second exposure draft, and that draft was exposed to a select group of constituents, some preparers, practitioners, and academics. They reviewed that draft and ultimately decided not to expose it publicly, as it was determined to be non-operable. So they went back to the drawing board again, and then in February of 2012 decided that the liquidation basis of accounting would be separated from the overall project and follow a separate track. And then follow on in July of 2012, an exposure draft was issued on liquidation basis of accounting that was exposed to the public. And then recently here in April of 2013, we have a final issued ASU, for which you can find another podcast on in the Financial Reporting Network. And then most recently here in June of 2013, we have going concern exposure draft, which was issued for public comment. So along this life cycle, some of the key items that were continually debated is a lot of discussion around some of the terminology that's used. As we think about a going concern standard, there's various thresholds and how those are defined, as well as some of the complexities that get involved when you start talking about what is a potential time horizon that an entity might need to be looking out in doing an assessment, such as a going concern evaluation, and how that time horizon really impacts and creates complexity for preparers when they're tasked with considering all of the potential events and conditions that might occur. So if you flip to the next slide, we also wanted to highlight, given the focus here by the FASB on this project over a long period of time, of course we believe that the PCAOB, the SEC, and the AICPA are all following this project closely and interested in the outcome. We anticipate, as the FASB gets closer to being completed with the project and we work through this comment period, that each of these constituent groups will likely be weighing in. We thought we'd highlight for you that as recent as June 30th of 2013, the Office of the Chief Auditor released their standard setting agenda, which they update twice a year. And on that agenda, they included a going concern project and highlighted with respect to timing that it was dependent on FASB actions. So I thought we'd just highlight for everyone that to stay tuned as to what's coming from other folks as this project gains momentum. So with that as a background, let's move right into the proposed standard. And so moving to the next slide on an overview of the proposed ASU. This proposed ASU would create a new subtopic, 205-40, going concern, which would reside under topic 205, presentation of financial statements. And as I mentioned in the overview, why was going concern really being addressed? Well, it was because no U.S. GAAP guidance about management's responsibilities in evaluating and disclosing going concern uncertainties resided in existing U.S. GAAP. And this principally put preparers in a sort of awkward position where the guidance related to this is really in the auditing literature. And as a result, we saw diversity in the timing, nature, and extent of footnote disclosures related to going concern presumptions. So this ASU is intended to really provide guidance on management's responsibilities and clarify when and how going concern uncertainty should be disclosed. So interestingly, as part of this ASU, it also amends the master glossary to include a couple of new terms. So the first one, the going concern presumption, is defined in the proposal as basically, will the company be able to continue to operate so that they can realize their assets and settle their obligations in the ordinary course of business? And then there's another definition, substantial doubt, which has been added to the master glossary through the proposal. And this is the sort of phraseology that we've been using in practice in the auditing standards, but this is really the first time it's been specifically defined in the master glossary. And substantial doubt being defined as existing conditions and events that suggest that it is probable that a company will be unable to meet its obligations within 24 months from the financial statement date. And that's including the management's entire plan. So when you look at the entire plan, we're talking about things that are both inside and outside the company, which would include any plans that mitigate those conditions or events that give rise to the uncertainty. And after going through that process, if at the end it's still known or probable that the company will be unable to meet their obligations within 24 months, then that's the threshold that's being defined here in the proposed standard. So I think it's important to note that when we talk about substantial doubt, it's been in the auditing literature for years, and there has been some debate in terms of whether known or probable threshold that's included in the standard is either higher or lower than what has traditionally been interpreted in the auditing literature. So if you read through the background of this proposed ASU, including the basis, you'll see that both the FASB staff and the board got feedback from a lot of their constituents that some folks thought that substantial doubt really meant more likely than not, which would be lower than this threshold. Some thought that it was at the probable, and some folks thought it was just a heartbeat away from bankruptcy. So there's clearly been a wide interpretation across auditors, preparers, and users of the financial statement on what substantial doubt threshold traditionally has been interpreted as. And as a result of this ASU, I think that will result in coming together in the view on what is the appropriate threshold. So with that introduction, let's move into the details of the proposal. And this proposal starts out with disclosure, and it's going to set out and require an entity to assess at each reporting period the entity's potential inability to meet its obligations as they become due within 24 months after the financial statement date. So that's going to be just a piece of the financial reporting process that's required by the standard. And when you're looking out at that 24 months from the financial statement date, you're going to have to consider all subsequent events up until the date that you issue your financial statements for public companies, or that they're available to be issued for non-public companies. So at the time when you're actually doing the analysis, there's going to be two triggers that will start out your disclosures about going concern. The first, if you conclude that it is more likely than not that the entity will be unable to meet its obligations within 12 months without taking actions outside the ordinary course of business, that's your first trigger. Then the second part of the analysis is if it's known or probable that the entity will be unable to meet its obligations within 24 months after the financial statement date without taking actions outside the ordinary course of business, then that triggers, that's your second trigger, and that also would trigger disclosures on going concern. So essentially it's a two-part test. And I know the first time going through it, the test may sound a little counterintuitive, and it's a lot to digest, so I'm going to go through it again just a little slower. So again, let's say we're preparing a set of annual financial statements, and we're doing the first part of the test. We're going to look out 12 months, and if it's more likely than not that you'll be unable to meet your obligations, then you would start the going concern disclosures. So that's a lower threshold in the 12-month period. And then you'd have to look next to do the second part of the test. We look to the 13 to 24-month period, and we'd say, are there conditions or events in that period that make it known or probable that you'll be unable to meet your obligations within 24 months? Again, without taking actions outside of the ordinary course of business, then that would trigger the going concern disclosures as well. And I believe the reason for the dual trigger, dual time period, why we do a more likely than not for the first 12 months and a probable for the next 12 months, is the board was trying to acknowledge the increase in difficulty for companies in making an assessment to make that conclusion further and further out from the balance sheet date. So we're looking ahead 24 months. It's a bit harder, obviously, to forecast what's going to happen. So I think that was sort of in recognition of the fact that if you're going to look over a 24-month time horizon, there should be an acknowledgement that the second half of that time period is going to be a little bit trickier because there's just less known or conditions. And again, just to give an example of how this comes into play, and the real stress point is, let's say you look out the first 12-month period and it's clear that you've got enough financing in place, you're not at more likely than not, but there's some event or debt is coming due in that 13 to 24-month period, and geez, you just don't know. You've got a lot of plans in the ordinary course of business. It's just hard to tell. You think you might be at more likely than not, but the stress is taken off in that period because you'd have to be at known or probable that you'd be unable to meet your obligations in order to trigger the disclosures. So in terms of what to disclose, so assuming you meet one of the two disclosure thresholds we discussed, we've got the disclosures in the bullets here on the right side of the slide. You'd need to be disclosing the principal conditions and events giving rise to the potential inability, the possible effect on the entity, management's evaluation of the significance of the conditions and the mitigating conditions and events if there are other things that mitigate some of the risk, and then management's plan to address the potential inability to meet obligations. So if you look at this in totality, we talked about the going concern presumption on the last slide, but really on the disclosures, the FASB chose to focus on ability to meet obligations as the thing you look at to determine whether or not you do or don't have a going concern uncertainty. So moving on to the next slide on conditions and events considered in the assessment. So this slide's got a whole bunch of bullets, and we'll try to boil down what we're really trying to get through here on this slide. The proposal does have sort of this laundry list of things that you need to think about on what sort of conditions and events might suggest an inability to meet your obligations. So these are things like, you've got a big piece of debt coming due, or you've got potentially adverse development in your customer relationships. Things that are inside and outside the company that could raise questions on your ability to meet your obligations. So many of these indicators are going to be the same ones that we use in practice today. And I think it's worthwhile highlighting, what are the sort of things that might cause a bit more conversation as the company's going through their periodic assessment of going concern. Probably two really important points. First is that when you're doing this assessment, it really is supposed to be kind of a holistic assessment. So we're taking a look at all the relevant data, all the relevant conditions around the company, and assessing the likelihood of being unable to meet your obligations. So that's the red box at the bottom of the page is really trying to highlight this assessment is made in the aggregate. And the second item that I think will cause a bit of debate is that once you kind of get together your whole assessment of all the particular conditions that affect that likelihood, that when you're evaluating management's plans to address those conditions, and when you're evaluating specifically the disclosure thresholds on whether you need to make the disclosure or not, you can only think about those plans that are in the ordinary course of business for the company. So this next slide talks about in or outside of the ordinary course of business. So once you've done your assessment and there's risk around or a heightened likelihood of being unable to meet your obligations, how do you evaluate which plan you can credit the mitigation of those risks to and which one you can't? And the standard works through what is considered outside of the ordinary course of business. So let's say I've gone through my assessment and I've concluded that before we take any management action, it would be more likely than not that I'd be unable to meet my obligations within the next 12 months. Well, that would be triggering our first disclosure. And then I'd have to evaluate, okay, what are my plans? And say, well, maybe I've got 3 or 4 different plans or things that I could do to mitigate this risk that's putting me at more likely than not. We have to make a determination. Are those plans in or outside the ordinary course of business? If they're outside of the ordinary course of business, then I need to disclose that fact that those plans are outside of the ordinary course of business. But the key point is I'm still in the disclosure requirements. So I can't say that, well, I'm at more likely than not, but I'm using these plans outside the ordinary course of business to mitigate my risk down to a point where I don't need to make any disclosures. Now, conversely, if you've got plans that are inside the ordinary course of business, then we could use those to mitigate our risk down below more likely than not, and we get to a place where we wouldn't have to disclose anything. So it's really sort of a threshold question of, are those mitigating plans in or outside of the ordinary course of business? So I think this is obviously going to be a very judgmental area, and the way that the proposal defines outside of the ordinary course of business is actions that are inconsistent with those customary in carrying out the ongoing business activities. And the proposal suggests that nature, magnitude, or frequency are items that we would consider. So if a particular plan is of a nature, magnitude, or frequency that's inconsistent with your customary business operation, then that would be a plan that is considered outside of the ordinary course of business, and it couldn't be considered for purposes of evaluating that initial disclosure trigger. If you look on the slide on the second one, there's also language in the standard that suggests that it is an entity-specific determination. So you could, and it says very explicitly in the proposal, that the same plan can be both inside the ordinary course of business for one company and outside for another company. So you really have to sort of look at whether the particular action, let's say it's a cost-cutting measure or debt refinancing, what types of actions, something may be very customary for one particular entity where the same action may not be for another. And so it does contemplate that this is a very entity-specific determination. There is a sentence in the proposal that we actually struggled a little bit with that talks about plans that are primarily intended to alleviate the specific risk, and that's the third bullet on the slide here. So the way it is sort of written is if you're doing a plan specifically to avoid or specifically to mitigate this risk, that you'll be unable to meet your obligation, that would generally be considered outside of the ordinary course because you happen to do something to sort of take care of this one particular risk. And yet the disclosure or the provision goes on to say, unless it is in the ordinary course. So it's kind of like, we think this is usually outside of the ordinary course unless it's inside the ordinary course. So as you can see, it's going to be a little bit confusing. I think there's obviously going to be a lot of judgment that goes in here in this area in terms of trying to draw that line between what we think is inside and outside of the ordinary course of business. So we have an example on the next slide of something that is outside the ordinary course of business. And this is actually an example that comes right out of the ASU. So in this example, we've got an entity that has got limited access to liquid funds to satisfy its debt that's coming due 10 months after the financial statement date. And we're going to assume that the debt is significant relative to the entity's assets, current assets, and equity, and that management has identified 3 plans to mitigate that risk. One plan is to lower operating expenses through cost-cutting measures such as entertainment, travel, and bonuses. The second is that they've started discussions with their current and other creditors to refinance the debt. And then in the event that refinance is not possible, they've also developed a plan to sell a major line of business equal to 1/3 of their operations. So the example on the proposal assumes that plan number 1 the cost-cutting measures, that they have previously taken similar plans in the past. So this cost-cutting wouldn't be something that was new and different for them. It also assumes that they haven't been actively refinancing their debt on a regular basis, and also that the major line of business that they would be selling as a contingency plan would be of a nature, frequency, and magnitude that isn't customary for the business. And so moving on to the next slide, the evaluation that's provided in the proposal with this fact set is that the cost-cutting measures would probably be considered to be inside the ordinary course of business because they're customary in carrying out their operation. The refinance, they basically said, kind of depends, right? Is the refinance something that could be considered of a nature, frequency, and magnitude that's customary for operations? In this particular example, it says that the debt is significant and they don't customarily refinance, so probably it would be considered outside the ordinary course of business. And probably selling a whole line of business, given the nature of it, it's probably going to be outside the ordinary course of business too because of nature, frequency, and magnitude. So there's obviously going to be a lot of judgment and a lot of questions, I think, still on how to deal with some of these refinancing situations. And what does it mean to be customarily refinancing debt, and what are the circumstances around that? So I think what we're hoping is that as this proposal gets flushed out a bit, we'll get some more clarity with some additional examples around making that call on in or out of the ordinary course of business for debt refinancing. So in this example, because you can't really consider the refinancing of debt or the selling of the line of business as being inside the ordinary course of business, if the other cost-cutting measures wouldn't be sufficient by themselves to alleviate or to reduce the risk below more likely than not to be unable to meet your obligations, then this would trigger the initial disclosures for going concern. So moving to the last slide that deals with the provisions of the standard, we're going to talk about SEC filer requirements. So all of what we've talked about thus far is applicable to all reporting entities, so both public and private. There is an additional piece of this proposal that's applicable to SEC filers only. And this is where we kind of circle back around to substantial doubt like we talked about at the very beginning of the program. SEC filers are required to determine whether there is substantial doubt about the entity's ability to continue as a going concern. And as we talked about on that very first slide, that substantial doubt exists if it's known or probable that the entity would be unable to meet its obligations within 24 months of the financial statement date, but you consider all plans that are likely to be effectively implemented and likely to mitigate adverse conditions. And you would consider all plans, which would also include those that are outside the ordinary course of business. So if you go back to that example we were talking about before, where we had a debt refinance and we couldn't consider it in evaluating whether disclosures were required to be made at the more likely than not level, when you do your substantial doubt analysis, you do consider all plans that you can conclude are likely to be effectively implemented and likely to mitigate the condition. So notwithstanding the fact that if you're doing that more likely than not analysis for the initial disclosure and you say, well, a debt refinance is outside the ordinary course of business, I can't include it, I have to put these initial disclosures in, then when you fast forward here and you say, okay, now I'm a public company, I know I've got my basic disclosures on because I reached that more likely than not, but I have to do my substantial doubt analysis, I can include the debt refinance as part of the conclusions I reach in that scenario. And provided that I conclude that it's likely to be effectively implemented and likely to mitigate the adverse conditions, then I would reach the conclusion that I haven't met the substantial doubt criteria. So to the extent that an SEC filer does conclude that there's substantial doubt, they will be required to say so in the footnotes. So as you can see on the slide, you need to make an explicit statement. And if there's substantial doubt about the entity's ability to continue as a going concern, the provisions of the standard also provide a little bit of flexibility in the wording right now, but the proposals do say, and it's on the right side of the slide, you need to make a statement such as there's substantial doubt about the entity's ability to continue as a going concern within 24 months after the financial statement date, or similar wording as the standard or as the proposal suggests right now. So the next key piece that's important as we go through the SEC filer requirements is that for non-SEC filers, this whole substantial doubt part of the model, at least in its current form, does not apply at all. So for non-SEC filers, you do not need to evaluate whether there's substantial doubt, and they don't need to make any explicit statement in the financial statements. There's also an expectation, though, that as more facts become known, for any company that's making these disclosures, that those disclosures will evolve over time. So let's say in your first period you're making the disclosure, as more information comes in and as presumably as the likelihood of you not meeting your obligations increases, there's an expectation that those disclosures will become more expansive. But in any case, the expectation is that those disclosures will evolve over time. And there's also some discussion. Let's say you've been providing these disclosures for a year and now you no longer meet the disclosure threshold. There does need to be some specific disclosure that bridges that so that the users can understand, how did I get from more likely than not in one period to now at a point where you're less than more likely than not. So to recap, the disclosure is going to be, or expected to be, a living, breathing, evolving piece of the financial statement as a company continues along its path over the 24 months. So with that, we'll move to the last slide, which is some forward-looking items. And with that, as we're moved to the last slide on going concern, which details some of the next steps, let's remind everyone of what we've got coming up. So as you can see on the slide, the comment deadline on the proposed ASU must be received by September 24th of 2013. Once all the comments are considered, there is a potential for another exposure draft to come out or changes to this proposed ASU to be recirculated. Certainly this may take some time, especially as you think about involving the other standard setters and regulators that might have a vested interest in changes to the going concern model. So again, we're very excited that the FASB has taken on this project to address going concern uncertainties, and we look forward to keeping you informed on future development. This concludes KPMG's podcast on the FASB's proposed ASU on going concern uncertainties. Thank you for listening.